Ladies and gentlemen, the state of the world economy, our expectations for global development, it's a very, very wide area. And so what we can observe in recent years is something I like to show you on the very first. Yeah, that's the one I would like to show you. Well, this is actually global trade in goods, and the yellow line you see is just the level, and the black columns are the percentage change against previous years. So what we can see is that over the last 2 years we see some kind of stagnation in the global goods trade. And I would like to focus on 3 points which might be the reason for this stagnation. And this is, of course, developments in the Eurozone. So we have to have a look at the Eurozone and monetary policy. We're going to have a look at the Fed policy. And, of course, one reason is the cooling of the economy in China. And I would like to dig a little bit deeper. What can we expect from China? What are the problems? What is the medium to long-term outlook? So, now it works. Perfect. For all central banks around the world currently, they almost face the same problem. They face a very low inflation rate. Here you can see the yellow columns are actually the targets for inflation for the G10 central banks, and the black dots are where we are. So you can see that obviously in the US, in Europe, in Japan, in the UK, in Switzerland, they almost anywhere actual inflation rates are far below central bank targets. So what is the central bank usually doing if inflation is too low? It is cutting interest rates. Now the result is this. The yellow columns are once more the range of monetary policy for the last 20 years. So in the case of the US dollar, you can see that 6.5% was the high during the last 20 years, and 0.25% is the low. And the black stripe is obviously where we are actually, so currently. So what you see is that all central bank rates are close to zero or close to a lower bound. Some of them are even negative. If you look at the Eurozone or Switzerland, we face negative interest rates for negative key interest rates. So that creates a problem for central banks because the usual reaction function didn't really work. They can't cut rates further, and inflation is still too low. So what to do? We call that monetary or expansionary monetary measures. Quantitative easing is one example for it. Quantitative easing means the central bank is just buying assets and paying with its own money. So that means they are injecting fresh liquidity into the market. But even after a couple of years of quantitative easing in the US and also in the Eurozone, and of course also in China, in Japan, we don't see that inflation rates are picking up. So what might be the reason why quantitative easing didn't work? One reason we can see in the US. On the left-hand side, the yellow line describes what I just said, quantitative easing. A central bank is buying a bond from a commercial bank and pays with its own money. So the liquidity, the money supply is increasing, and this is the yellow line. These are trillions of US dollar. But when it comes to inflation, it's not sufficient that there is liquidity in the market if the money is just in the banking system. We need the money in the economy, the liquidity. And unfortunately, if you look at the black line, which is money supply M2, this is far from where you would expect it when you see the liquidity measures by the central bank. So actually all this liquidity is created, but it's not reaching the real economy. It's just sticking in the banking system. And the second point, obviously, is the velocity. How much money do we need to run an economy? We need less and less liquidity. So that means the velocity of money is sharply decreasing. So that's an explanation why quantitative easing did not fuel inflation in the US. If we come to monetary policy in the US, there was, you might know that the FOMC met last week on Wednesday to decide on the future interest rate policy. And I'm looking at foreign exchange markets, and that created a very funny situation. What happened? Well, actually, the FOMC tried to give a very strong signal to the market that interest rates will be hiked at the end of the year, most likely in December. That was done by a change in the statement where they added a sentence that the case for rate hikes have improved, and in the Q&E session, Chairwoman Yellen was pretty hawkish. Most important signal was that 3 of the FOMC members already voted for a rate hike. So they dissented from the official statement. And currently, there are only 10 FOMC members in office. So 30% already dissented. 5 years ago, this would have been a very clear signal for financial markets that there will be an imminent rate hike in the US. Last Wednesday, the US dollar lost ground. Usually you would expect a currency to appreciate if we expect higher interest rates. That makes the currency more attractive due to higher carry. This time it was different. Yeah? The US dollar lost ground against almost all major currencies. Why? You can see it in this chart. The yellow line is the market expectation for the key interest rates in the US at the end of 2017, so the end of next year. Why is it a market expectation? It's a market expectation because we derive it from a future. So this is actually people paid money for this, so this is not just a funny bet, these are market expectations. And you can see that for the end of 2017, the expectations decreased since quite some time, and now the expectation is for 1, maybe 1.5 rate hikes until the end of next year. Now the black dots, this is the expectations from the FOMC itself. So all members deciding on the key interest rate in the US, they are being asked, what do you think will be the appropriate key rate at the end of 2017? And you can see that they are not all of the same opinion, but the most important thing is that usually all dots are above market expectations. So the FOMC is expecting higher interest rates than the market, but the dots are falling. So we have a situation where the FOMC, the Federal Reserve, always states that they are going to hike interest rates, they are ready to do it, but they just did it once. And now the market feels like they might not do it again. So it's a lack of credibility in the US monetary policy. The market simply does not believe what the Fed says anymore. And this is, of course, another problem for the central bank, because if you lose your credibility in the market, it will be very difficult to create the desired inflation targets. What is the situation in the Eurozone? It's even more difficult than in the US. The central bank in the Eurozone, the ECB, is buying bonds for 80 billion euros a month. 80 billion euros every month. And I would say almost 99% of this money ends up in excess reserves of the banking system. Why? Well, imagine there are two things we have to understand. The first is that each euro which was created by a central bank, or you can say a dollar, or you can take any currency, right? At the end of the day, this euro, dollar, yen, or whatever lies at the central bank, at an account of a commercial bank. Let's say I'm the ECB and you are a commercial bank. Now the ECB is trying to buy a bond, quantitative easing program. So I will give you a price and you will sell this bond. What do you get? You get some money from ECB and it is on your account within ECB. Now, you might decide that if you sold a bond for 10 million, this is too much liquidity. So you buy a bond from another bank for, let's say, 5 million. So then your liquidity is 5 million less, but the other bank has 5 million of more of liquidity. And at the end of the day, you have to put this money, if you are not able to keep it cash, and this is not possible for 80 billion euros a month, you have to keep it at an account within the ECB. And unfortunately, the ECB now has negative interest rates, 0.4%. So if you keep a million, you have to pay 0.4% on the year just to keep the money within the ECB. And this interest fine applies for all deposits you have which exceed your minimum reserve level. Every bank, if a bank is giving a loan, they have to put some money on the ECB account. We call that minimum reserve. For this reserves, you don't have to pay these 0.4%. But everything above, you have to pay for. Now, unfortunately, if the ECB buys bonds for 80 billion euros a month, these excess reserves will increase by 80 billion euros a month. There are only two possible ways to avoid this. One way would be to keep it in cash. This doesn't work. And the other way would be to create more credit. This is actually what the ECB wants to force the banks to do. But as we have excess reserves, you can see that excess reserves have been a lot of, let's say, above 700 billion euros for almost half a year. So the banking system paid 0.3, 0.4% interest on these reserves without being able to create more credit. So how can you expect that if the excess reserves will climb above 1 trillion, that suddenly the banking system will start to create credit? If they are not able to create credit and pay fine for 500 million, it doesn't make sense to increase the pressure. Now, what does it mean for the real economy? Well, just remember what an expansionary policy usually does, monetary policy. It means the central bank is lowering interest rates so that the funding for the banking system is cheaper, and then you as a loan taker, you get a better rate. And if interest rates for the corporates are lower, the demand is rising, the economy is getting traction. So that is the idea of expansionary policy. In times where the economy is overheating, the central bank is usually hiking interest rates to make funding for banks more expensive. So interest levels for the corporates will be lifted, and the demand for loans will decrease, and the economy is cooling down. But now look what is happening with the quantitative easing and at the same time negative interest rates in Europe. This is not an expansionary policy, it's a restrictive policy, monetary policy, because it is increasing the costs for the banking system. We just said that expansionary monetary policy means lowering the funding costs. But now the banking system has to pay 0.4% on 1 trillion euros, so that is about 4 billion euros a year. This is additional costs, and as it is very, very difficult for the banking system to pass on these negative interest rates, of course, they have to have a higher margin on corporate loans, for example. So this policy, if you have, and the ECB is the only central bank in the world who has at the same time negative interest rates and quantitative easing. So this is the reason why we see a very bleak picture when it comes to credit growth in the Eurozone. So, and that's one reason why the Eurozone is growing at a stable rate, but it's not very high. It's not what we would wish to see. So my conclusion is it's a mistake in the structure of monetary policy. You can have negative interest rates or you can have quantitative easing. But if you do both, the banking sector will be punished. Third point, and most important one. Well, we were used to see growth rates announced in China about 10% for quite a lot of years. Currently, the official growth target in China is 6.5 to 7%. After a very weak first quarter, we've seen a better second quarter, but figures coming out of China are very, very difficult to interpret. Just one example. While China is a very big economy, China is the first economy worldwide which is announcing the quarterly GDP data. They are the first country where this statistical office is ready, for example, to announce GDP data for the second quarter or third quarter. And China is one of the very few countries which never revises these figures. So being the first to announce them and never revising these figures, my conclusion would be that all statisticians over the world should travel to Beijing to learn how to create proper statistics, because they are too slow and they provide wrong figures in the first reading. Or we have some doubts on these Chinese figures, which is my explanation for that. So even the figures we've seen in the first half of the year, that's about 6.5%, might be a bit too high. They might be lower, in fact. But without any doubt, these figures in the second quarter were supported by government action. We see a very loose monetary policy, that's one point, but we see also a growth in credit. Now, in the Eurozone, we are waiting for more growth in credit. In China, it might be more difficult. So, and that's why I would like to confrontate you with 4 problems of the Chinese economy. This is not exactly the picture you are used to be getting presented over China, which is usually China is big, fast growing, such an important country. The yuan is a world currency in a couple of years. So all this is true, but there are some severe problems I would like to talk about. The first problem is capital outflow. Now, you might be aware of this story about emerging market when it comes to rate hikes in the US. Even the Fed mentioned that it will create a very moderate rate hiking cycle to make sure that emerging markets are not hit by higher interest rates. Why are higher interest rates a problem for an emerging market? Well, usually an emerging market is importing more than it exports. Okay, so it runs a current account deficit. Now, if you run a current account deficit and you want to be able to pay for your imports, you need to get the money from somewhere. And this is usually, you get it by capital inflows. So you have investors investing in your country. And obviously, if the US dollar is creating a more attractive yield, the incentives for investors to invest in an emerging markets are a bit lower. So the fear usually is that emerging markets are hit by higher interest rates in developed countries because it will be more difficult to finance the current account deficit. In China, we have a different situation, but the result is almost the same. If you look at the yellow columns, you see that China is running a current account surplus. We know that China is exporting more than importing. But due to all these liberalization steps China introduced over recent years, we see a lot of capital outflows out of China. And the capital outflows is the gray column. That's why it is negative. Now, what you see immediately is that the gray column obviously is much bigger than the yellow one. So the capital outflow is much higher than the current account surplus. How to finance the difference? Well, China is financing this difference via lower foreign exchange reserves. Because the central bank needs to provide dollars to corporates because otherwise they wouldn't be able to import their desired goods. So what we see is usually an emerging market has some kind of a negative yellow line and needs a positive gray line. In China, the problem is the same. The surplus in the current account is not sufficient to create enough surplus for all these capital outflows. So that's why they need to spend their foreign exchange reserves. Now, unfortunately, well, China has a lot of current account foreign exchange reserves, a lot. This is what you can see here, left-hand side, almost 4 trillion foreign exchange reserves. What you see at the end of the chart is that it falls steeply. And financial markets are reacting in a very special way to such a development. They don't say, well, it was 4 trillion, now it's 3.5, and 3.5 trillion is a lot. No, financial markets are asking how long does it take to be at zero. And if you see the speed here, you would say, well, maybe 2.5 years. That would mean in 2.5 years, China doesn't have money to pay for all these imports anymore. Even if the imports are lower than the exports, because so much money is leaving the country. And what you can see on the right-hand side of already exports and imports, you see that exports are falling slightly, but imports are already falling much more severely, right? Because some of the importers are already facing problems to get a dollar funding. So what can the Chinese authorities do? Well, of course, they can spend foreign exchange reserves, but they have to do it in a way that the market is not concerned about the speed of the decrease in the foreign exchange reserves. That's what they do currently. And then, of course, they can take back some of the liberalization structures they implemented over the years. And they are doing this. If you try to create some cash pooling for corporates, for example, which was a very good way to get money out of the country, you cannot do it anymore. So they closed some of these capital account liberalization process. And of course, we have to think about the Chinese currency. Because if the currency is under severe depreciation pressure, the intentions for Chinese investors to put money abroad, to create more capital outflow, are increasing. 5 or 10 years ago, we were used that whenever you get your money into China, even if your investment is not perfectly running, you're definitely going to get some gains on the foreign exchange side. This changed completely. We saw a lot of depreciation pressure on the CNY this and last year. So the authorities need to make sure that there is not too much depreciation pressure, because that would definitely increase capital outflows. But they cannot do it by just intervening in the market, because that would lower the exchange reserves too quickly. So they need to do all three things. So they accept a slightly weaker currency, slightly decreasing exchange reserves, and they take back many of the liberalization steps provided over recent years. So this is the first problem. And I can tell you that even if you try to solve the problem via different channels, there is only a certain time window you have to solve these problems. So China needs to find a solution for these capital outflows. The next problem is overcapacity. I won't talk about steel overcapacities in China, because I'm not an expert on that. And so all I want to do here is, of course, you can see that there are overcapacities in the steel sector, but it's not only steel, it's also aluminum, cement, refinery, glass, and paper. What you see here is production and capacity. These are data from the European Union Chamber of Commerce in Beijing. Yellow is production and gray is capacity. The first dot is 2008 and the second dot is 2014. So for example, if you look at steel or aluminum, you can see that also already in 2008 there were a severe oversupply. The gray dot is above the yellow one. But even though that there has been an oversupply, the capacities even grow faster than the production. So overcapacities today are even higher. And this is not only true for the steel industry, it's also true for all these other industries. Well, how can this happen? Usually if there is oversupply in an area, it's not really worth investing there. And it definitely is not. The problem in China lies in the reason that a lot of corporates in China are state-owned. We have 104 state-owned enterprises which are owned by the central government, and on average, just to have an idea how big these corporates are, each state-owned enterprise has on average 1,000 subsidiaries. So 1,000 smaller corporates which are owned by these enterprises. And now imagine you are, let's say, a cement producer somewhere in China. Now your local government has a very strong incentive to create employment and GDP growth, because this is the only way to make a career in the party, right? And so if you own a very large cement producer and you have overcapacities, it doesn't make sense for the local government to shut down this producer, because it would create a picture of a lot of unemployment, no GDP growth. even if you cannot sell your products, one possible solution is just to build a bigger plant, because that also creates growth, investment growth. Now, in the Western world, you would face a problem because no bank would fund that, right? But fortunately, this local government also owns a local bank, a state-owned bank. And this bank is eager to fund this new investment for two reasons. First of all, it's state-owned. And second of all, as long as this enterprise is working well, it doesn't have a non-performing loan in its books. So that's the reason why we see higher or significantly growing capacities in overcapacity sectors. From time to time, there are attempts of the central government to shut down corporates or enterprises in overcapacity sectors. Refinery is one reason. In 1999 and in 2004, there had been some attempts to close smaller refineries. So the central government said every refinery below 50,000 barrels a day need to be closed. Do you know what the local governments did? They just made sure that as quick as possible, these refineries were able to produce more than 50,000 barrels a day. So, because then you don't have to shut it down anymore. So, China is not a market-driven economy, but the idea that the central government is just giving some kind of order and everybody is doing that is also wrong. It is. I had a meeting with the PBOC, that's the Central Bank of China, last week in Frankfurt, and I talked to them about this SOE problem, and they said, yeah, well, whenever we try to cut down these oversupply sectors, it is very, very difficult to get traction on what the local governments are doing. You have to know that within China, even corporates sometimes have to pay tariffs because they are not coming out of a certain region in China. If you are from a different region, you have to pay taxes, more taxes than a local corporate has to pay. So the idea that overcapacities will lead to less investments are currently not working in China. And of course, overcapacities are pushing prices lower. Here you see the yellow line is the usual consumer price index, and we see that producer prices are in negative territory. Usually they run more or less in the same direction, but of course overcapacities are pushing prices lower and are weighing on profits. And here you can see it again, because we divided private enterprises and state-owned enterprises. The yellow line is state-owned electricity. Yeah, now it's better. Well, if this doesn't work anymore, I'm done. So the yellow line are private enterprises, and the black one are the state-owned enterprises. And here you see industrial profits year to date in percent. So what you see is that state-owned enterprises, the profits are falling. Profits in the private sector are still growing, even not very strong anymore, but in the state-owned sector, profits are already falling. And the next chart is, if you think about this, much of a surprise. This is investments. Again, yellow, private sector, gray, state-owned sector. And now you can see that the sector which is facing decreasing profits is investing significantly, and the private sector, which is still running pretty well, is cutting back its investment growth. Again, the reason is what we saw, that for a local government, it simply doesn't make sense to stop investing even if the enterprise is working in an overcapacity sector. So, and of course, one reason is government incentives. Yeah? Banks were asked to provide more credit. And usually this credit goes into the state-owned enterprise sector, which means that we see some kind of crowding out for private investments. Not last but not least, it's only the fourth problem. There will be another one. What we see is that the corporate sector in China is already highly indebted. This chart looks a bit difficult, but actually it's very easy. On the vertical axis, on the horizontal axis, you see the debt to GDP ratio of the corporate sector in percent. And on the vertical axis, you see the change of these figures in percentage points since the financial crisis. So if we look at, let's say, the EU, for example, we see that the corporate sector is indebted by some 110%, and this was increased, has been increased since the financial market crisis by about 10 percentage points. Now, do you see where China is? It's on the very top. So the corporate sector is indebted by about 170%, and even more worrying, since the financial market crisis, this debt was increased by 70 percentage points. Once more, the reason is that obviously even corporates, which in the Western world would just be shut down, are still getting credits. And they need more and more credit because the business is not running. And we can prove that this is a problem created by the state-owned enterprises. Again, we have, no, this time I mixed it up. The yellow one now is the state-owned enterprises. And gray or black is the private sector. I should have done it the other way around to make you more comfort. Okay, so black is private, yellow is state-owned. And what you see here is the 90th percentile of private and state-owned enterprises if you look at the dotted lines. So 19th percentile means, if we look at the yellow line, for example, we take this 10% of most indebted corporates within the state-owned sector. Yeah, we order all corporates by their debt, by their leverage, and we take the 10% who are most indebted. Now, if you do that for the private sector, so the dotted black line, you can see that there has been a strong deleveraging process, which is usually to be expected. If your debt is too high, on average, you're going to lower your debt, your leverage. And of course, it is different for the state-owned sector. Even the 10% mostly indebted corporates are still increasing their leverage. And the reason, once more, we already talked about that, is that it doesn't make sense for a local government to shut down a corporate or an enterprise. Now, of course, we have to very short look at the development of the CNY, because what happened on the FX market also gives an indication how the Chinese government is actually reacting on all these problems. What you see here is the spot rate and the fixing rate. The red line is the spot rate, that's how Euro CNY trades on the market. And the spot rate is a rate set every morning by the PBOC, and then there is a trading band where the currency can trade this very day. The trading band is the gray area, and you can see that this trading band has been enlarged sometimes. Now it's plus minus 2% currently. Now, until September, or actually until August 2015, you see that there was a strong deviation between spot and fixing. That was just due to the fact that the fixing was actually done by the PBOC, and if they fixed, let's say, the rate at 620, and the market was trading at 640, it didn't mean that the next day's fixing would be 640 around. They just, it could move 2% each day, but they can just set the fixing wherever they want it. So it's not market driven, all right? And then there had been an announcement on the 15th of August in 2015 where the PBOC asked the market makers to provide better prices for the fixing in the morning. Now, obviously, that's just a political statement, because I'm very sure that every market maker will provide a recent, a very market-driven price. Otherwise, he would constantly lose money. But the PBOC didn't like to say, well, we didn't do our fixing properly, so now we want to change it. So they just blamed the market makers for it. And they asked the market makers to take into account the previous day's close if they come to provide prices for the next day. So that created a situation that if there is a fixing in the morning and then depreciation of the CNY, you can see this depreciation in the next day's fixing. And that's why from that very day, you actually just see just one line, because spot and fixing are very close together. Now, what unfortunately happened is that dollar CNY spiked significantly higher, because the market already was speculating on a weaker CNY. So after some time, the PBOC changed this system again. Well, the first thing was that they said, well, you still look at previous day close, but the closing rate is derived at 4:30, but trading continues now to 10:30 in the night. So again, there was some kind of mismatch between spot and fixing. And today it's even more difficult because the PBOC is talking about a basket. They named the currencies, but they didn't really name what actually they are doing with this basket and how much depreciation or appreciation pressure they accept. So today we are very close back to a situation where we have a model every morning what we expect for a fixing rate, but there are severe deviations from that model. So there is more intransparency again in the fixing or in the FX market. At the beginning of 2016, you might remember we had a time where risk perception spiked due to problems in the Chinese equity market. Equities were falling very sharply, and everybody was a bit surprised by that move. Now, if we look what happened at the beginning of January 2016 at the equity market, the story is very short. Half a year before, there were also some days where equity markets lost some ground. And the government didn't like it. So they just said that all major investors are not allowed to sell their stocks anymore. Major investors is everybody who owns more than 5% of a corporate, of all stocks. So these investors were forbidden to sell their stocks for 6 months. Now at the 8th of January 2016, period of 6 months came to its end. Now, what do you expect all the minor investors are doing when they know that in 2 or 3 days all major investors are allowed to sell their stocks again? Well, obviously they sell before. And that's what created all these problems. And then we saw some reactions of the Chinese government which were very unusual compared to what we see over the last decades. Suddenly there were some emergency meetings overnight. They created new rules for the equity markets in a couple of hours. Like one that if the index drops 5%, there will be a break of trading for 15 minutes. And then they continue trading, but if it comes to -7%, the trading stops for the rest of the day. Now, they introduced this rule on a Monday, and they canceled this rule on a Wednesday. Because what happened? Well, all investors realized that if they want to sell their stocks, they should do it very early in the morning before the trading stops. So on the Wednesday, it took us 15 minutes to reach -5%, and they stopped for 15 minutes, and after that it took a couple of seconds to be at -7%, and the trading was stopped. So these rules were actually making very early sales more attractive. They triggered the investors to sell their bonds very quick, or their stocks very quickly. It clearly shows that the Chinese government did not understand how financial markets work. They are rather used to give rules, and then these rules have to be applied. The problem with financial markets is that sometimes you have to accept a result you don't like. That's true for all governments around the world. But if you prefer market-driven economy, and you have to accept the market forces, even if you don't like these results. So my conclusion out of this is that I do not expect that the government in China is ready to accept all the negative consequences they would face if they really tackle the problem of state-owned enterprises and overcapacities. They will not do it, because that would, of course, create a lot of unemployment and a period of very low, perhaps even negative growth rates. So that means all the problems we were talking about already definitely will not be solved over the next couple of years. Last but not least, there is a problem called demographics. China is usually taken as an emerging market and usually we talk about emerging markets. These are fast-growing economies with a young population picking up to developed markets. Unfortunately, data from the United Nations come to the conclusion that Chinese are getting old before they get rich. How can we come to that conclusion? So on the left-hand side, you see something we call old age dependency ratio. That means that's the share of old people, usually retired people, compared to your working population. So the higher this ratio is, the more money you need to spend for your pension system. If you look at the left-hand side, at the yellow, at the red line, China, so the old age dependency ratio currently is pretty low. But the projections of the United Nations show that already in 2050, the old age dependency ratio will be about the level of Germany and even higher than in the US. Now, these are forecasts for 30, 40 years, but these are demographic forecasts. And we already know how many people were born and how many people will be in a working age in 40 years. So these projections are very solid. it's not, we would never be able to give any projections on GDP growth in 30 or 40 years. But if it comes to demographics, this is easy possible. So what we see is that there will be a sharp spike in this old age dependency ratio in China, which of course means they have to pay more for their pension system. But even more important, on the right-hand side, China's working population, the labor force potential, is already decreasing. And this is something which the government is also tackling. How can they tackle this? Of course, they can tackle this by urbanization. Usually an urban worker is creating more value added than a rural worker. So this is something which is the government using, and that's why they changed the Hoku system. The Hoku system means in China you're not allowed to live wherever you want. You are born in a city, and then you have the right to live in this city and to work there. Now, if you want to move from one city to another city, let's say you want to move to, I don't know, Shanghai, it's still forbidden. You're not allowed to do that. So currently in China, we have about 300 million people living in areas where they are not supposed to live and where they are not allowed to live. And this means that they are not able to enter the school system for their kids, for example. The education system is not working properly because there are a lot of illegal people trying to work in cities where they are not supposed to work. So that's why the government lowered these barriers, how to move from one city to the other. But they lowered it only for cities where, let's say, for example, property prices were not too high. It is still very, very difficult to be allowed to move to Shanghai or Beijing. The second and third tier cities, it is now more easy to move there, and this is one of the attempts the government is running currently to fight this problem of lower labor force potential. Because if your labor force potential is falling, you can make up with, of course, higher productivity of your labor force. And that's what the government currently is doing. But as I said, the real problems will emerge only in 10 to 15 years. And this is, as I said, the fourth problem where China needs to find a solution for. So all in all, my conclusions, we have an outlook for China where I would not expect Chinese growth to pick up anywhere over the next 5 to 10 years. It might be even very difficult for the government to stick to the current level of GDP growth. And we have a monetary policy worldwide with very, very low interest rates, which does not find channels like we were used 10 years ago, where expansionary monetary policy would lead to higher GDP growth. So the outlook for the global economy is not recession or something like this, but don't expect the economy to pick up significant speed over the next couple of years. Thank you for your attention.
Thank you very much for this detailed presentation. Are there any questions for Mr. Karpowitz from the board? Sandeep?
Hi. The Chinese government is talking a lot about moving away from a fixed asset model to a consumption model. Is there any evidence that this is actually happening?
Well, what we see is that the share of consumption in GDP improved over the last 10 years. And fixed asset investments lost some shares. But that was a speed where we would not say that we see this shift of economic model, right? And of course, one reason is that investments will only be lower if you really run some kind of market-driven economy. There are still too many investments which are just state triggered by this, by governments, local government, central government, and so on. But I agree that there is some kind of improvement on that in that case. But don't forget that this idea of a consumption-based economy is also a very political idea, because it was created when China faced a lot of attacks by especially the US government, that it is just creating too much exports, right? And we are talking about exports, you know that from steel sector, where we are talking about exports which sometimes are even below production prices. So, and one reaction of the government was obviously to create some kind of story that they will shift to a consumption-based economy. They did it to some extent, but it's also just some kind of label to create not too much conflicts with other economies, right?
Thank you.
Going back to Europe, you originally mentioned that the European banks have a lot of cash and they're looking for investments, and there's obviously negative interest rates. So what kind of investments are the European banks looking, and what kind of investments do you think that there will be happening in Europe, other than the government, infrastructure?
Well, yeah, of course. Well, if we talk about these excess reserves you mentioned, right? Of course, the Commerzbank, where I'm from, also has a lot of excess reserves, and we pay negative interest rate on it, and we don't want it, right? So, of course, we can try, let's say, we can say we take an investment in Hungary, Poland, somewhere abroad, not in the euro area. But that doesn't solve the problem, because then we would buy foreign currency to invest abroad, and somebody else would just buy our euro. At the end, it would not change the excess reserves in the banking system. So, yeah, we can invest in our country because there's no credit demand. Demand for credit. Of course, we would. The problem is that on the one hand you have a lot of liquidity, and everybody wants you to provide credit. On the other hand, I can tell you that with the new supervisory restrictions, it is so difficult to provide new credit that you just cannot do it. So what happened after Lehman, actually? After Lehman, the authorities decided to make sure that Lehman will never happen again. So their ideal world is that a bank can never go into default. A bank should not take any risks. But imagine if a world where nobody takes risks doesn't move. Nobody of you would sit here if there wouldn't be a founder of a corporate who did take risk in the past, right? So what we currently do is, on the one hand, we want banks to provide credit, and on the other hand, they are not allowed to take any risks, and that doesn't fit together.
So you have the same problem as the US?
Yes. It's even worse than in the US, because we pay negative interest rates. The US doesn't pay negative interest rates. No, yeah, well, we are waiting for a rate hike. It's I know that you're not the only one who is not gay.
Thank you. Sure. Any other questions from the floor? No, I guess so. So thank you very much once again.
Thank you. Thank you.